Hello and welcome. Mansur Sharif here with another important international accounting standard, IAS 21 Foreign Exchange Rates, which addresses the effect of change in foreign exchange rate on financial statement. In this video, we will try to cover these topics one by one: the recognition criteria, the measurement criteria, and the exchange rate differences, how they differ from one another, why they differ. We will try to cover these things in this video. Before going into the much detail of IS 21, let's try, let's see why IS 21 matter, why it's important. As we live in a global economy, businesses might buy, purchase in different currencies, like we buy material in dollars and sell product in rupees. Because of the exchange rate every day, it changes every day. These fluctuations can make profit looks too high or too low if they are not correctly recorded. IAS 21 ensures that currency movements are reflected accurately so we don't distort the true performance of their businesses. Here are some terminologies: the presentation currency, the functional currency. We will look into it in this video. Next, we have the definition of IAS 21. IAS 21 covers the accounting of foreign currency transaction, translation of foreign operations, and recognition of exchange differences. After that, we have the scope of IAS 21. IAS 21 applies to foreign transaction, foreign balances, and operations, but it excludes hedging accounting techniques. Next, we have the functional currency. We will try to understand what is functional currency. The foundation of IAS 21 is functional currency. This is simply the currency of the main economic environment where the company actually operates. It determined by what currency set your selling price, pays your labor, and funds your loan. A company can only have one functional currency. It's the real money that we use to survive and operate. And next is the presentation currency. Presentation currency is the currency in which the financial statements are presented to the shareholders, to the stakeholders. This currency is selected by the entity by its own. Next, we have initial recognition criteria. How we will recognize it? When a foreign currency transaction first happens, like buying goods from a foreign supplier, we record it using the spot rates. We will record it at the starting at the spot rate. This is just the exchange rate on that specific day. It captures the true value of the transaction at that moment. Here we can see that uh, as we have a Mexican entity is here which selling goods to some German customer, and they have created a receivables in euros, and as the Mexican entity is the subsidiary of an American parents company, he has to present it he has to present it their financial statement in USD. And now here the USD is the presentation currency which the entity will present it. Entity will present it to the parent company. Here the functional currency is the euro and the presentation currency is the USD dollar. Next we have measurement at reporting date. What happens when we reach at the end of the year? We have to treat two type of items differently. First, monetary items. This is a cash, money owed to you or money you owe. These change value every day, so we must update or retranslate them using the closing rate balances on the balance sheet date. Second, the non-monetary items like land or inventory which carried at cost. These usually stay at the historical rates. The rates from when you bought them. We don't revalue them unless specific rules applies to them, to the non-monetary uh, items. Here we will look that assets, including goodwill and liabilities, these are recorded at what rate? At the closing rate, income expenses, other comprehensive income at historic rates or on the average rates. The share capital and equity rate, these are not specified. It's depend on the management judgment and how to present these differences. These differences are presented in other comprehensive income. Next we have exchange differences or the functional currency. When these exchange rate changes, we get a difference in the value of the currencies. Generally, these differences go straight to profit and loss. This means if your currency weaken and your debt go up and your debt go up, it hits your net income immediately. This is what we have talked about before. Now we will try to understand IS 21 through a short example. Let's look up a simple example. Suppose when we buy raw material on credit for USD $1,000, on the day of the purchase, the rate is we suppose that it's 280 rupees per dollar. So we record a liability of 2,80,000 rupees. At the year end, when we look at the rate, it has observed that it has moved to 285 rupees per dollar. Now we have to revalue our debt as $1,000 multiplied by 285 is 285,000 rupees. Now our debt has increased by 5,000 rupees. This extra cost is a exchange loss. To record this, we debit exchange loss for 5,000, which reduces our profits, and credit the payable for 5,000, which increase our debt to its current real value.